This is Smart Investing with Mike.wren.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren. With Michael's producer, Chris Martin. You can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike.wren.
Hello, everybody. Thank you again for downloading or listening to another episode of this podcast of the Smart Investing Show, where we try to take the topic of investing. Number one, we try to make it easier to understand. Number two, we try to get you good, relevant information on each and every show. And thirdly, we try to be entertaining. And usually the entertaining portion is the president of all the Northwest Comic Cons in the world, Mr. Chris Martin, here sitting across the kitchen table from me once again.
I would not want that job.
Why not?
I'm privy to a lot of emails that the owner of Lilac City gets. Sometimes his wife will pull her hair out and send me a screenshot of some of them. And there's some not smart people out there in the world. There was she sent me one the other day that a woman said, "I took photos of my child at your Comic-Con, and so how do I get those?"
What?
That was her email. "I took photos of my child at your Comic-Con. How do I get those?"
How did she?
They're on her phone.
Yeah.
But she had to ask somebody because she didn't know. I mean, that's the kind of emails that they get, and there's no way I could answer those.
Yeah. That sounds like some of the ones that I get. I'm just teasing. No, I'm not. Yes, I am. No, I'm not. So
there's what was it? Tracy Ullman said, "There's truth in all humor."
Oh yeah, a little bit.
Yeah, sure.
Yeah, a little bit. So hello to all the listeners out there, all 17 of you. I am glad that you're listening again to this show. And let's see, today's show. It's hard for me to do today's show because I don't know what the hell to talk about because it's all normal for me. You know, acting in a non-emotionally charged way with money, that's normal for me. So it's hard for me on some shows to put myself in the place of different listeners out there or the public and be all up in arms about something that's truly meaningless.
Well, you're at a disadvantage because, one, you're not being paid by a company to ramble on about something, and then also we don't have to worry about ratings, so you don't have to hyper something up that's not real. And
the real downfall is right now is that a perceived downfall. We're not live on the radio right now, and usually on these shows, I can remember in the past where I would say it's a difficult show, don't have anything really burning a hole in my head of what I want to talk about, we wouldn't get a call. I would tell, remember those shows? I would say time and time again, hey, if you have a subject that you want us to talk about, now would be a really good time. Crickets.
Yeah.
And then when there's plenty to talk about and we're on not the simplest topic, somebody would call in, what's an IRA? And So I have to be careful what I'm missing, or not missing, or what I think.
Careful when you ask the public for help. Is that?
Yeah.
So let me ask. Okay, so I'll geek this for a minute. So during the con, I had a trivia contest. It was called Win My Stuff, and I just brought some stuff from home, and I thought it'd be fun for people to win it. So,
hold on. I might have a problem with that premise right off the bat.
A remote-controlled R2-D2, a Thanos glove. It was some good stuff.
Again, people,
I have books and
I have some shit at home that I think some people might like to have.
This was stuff that I bought, and then I looked at and I went, why did I buy that? So
okay.
So I asked for 3 volunteers from the audience.
And
no. I know, right away. First off, none of them, I had a bunch of questions about Michael Keaton. None of them knew who Michael Keaton was. Then I asked, let me see if you can answer this.
How old were these helpers?
That's the thing they were like in their late teens.
Okay.
I was just corrected.
What's correct?
It's not a Thanos glove. It's a gauntlet.
We were corrected by, we have a fact checker with us today.
Where were you during my trivia contest?
Yeah, so we are so high and mighty now. We have a fact checker like the the sports shows do.
There we go.
And luckily, we don't pay her a thing.
No.
Yeah, it's free.
It's an internship. So asking the public for help. So let me ask you a question because no one got this.
Okay.
A man who just died recently who created the Marvel comics. A very older man who just died who created all of Marvel comics.
I don't know. I don't know who created the Marvel.
Okay, he's famous for saying Excelsior. Nothing?
No.
I know. She's waving. The intern's waving. Stan Lee.
Okay, I know that name. I just didn't know that he was the creator.
Yeah. They didn't.
He's known for the artwork, right?
Well,
or am I wrong?
Well, yeah, it's mainly stories.
Okay.
But, they didn't know who created Marvel Comics, and they're at a Comic-Con, and they didn't know who Michael Keaton was.
Well, you just asked
the
hugest money nerd in the world, and somebody who looks
nerd.
Yeah, measures, has a micrometer to measure tolerances in an engine. You're asking me about comic books. So I think it's good that I failed that one.
Oh, okay. Yeah.
Maybe.
It's good that I didn't show off that I'm a nerd.
A different nerd.
Yeah.
Yeah, a blue-collar nerd. There we go.
Oh.
Yeah, somebody who actually goes to the Duluth Trading Store, who looks at those commercials on TV and says, maybe that shirt will make my fat belly cooler. We'll try it.
I think I will like to try on your underwear.
Yeah.
That's why I'm not going. At least if I shop online, I know no one tried them on. If I go to the Duluth thing, I'm not picking underwear off the rack.
I don't
know who tried those on.
I've never even considered that a thing.
Yeah. Well, It's a store, isn't it? When you go to to a clothing store, people have tried those clothes on.
I've never tried
That's why there's a
underwear on.
dressing
I
room.
just buy it and go.
You don't know.
Okay.
You see them hanging on the rack.
Well, okay. Yeah. Wow, this show has really taken a turn. I'm sorry for you, the listener. So let's get a hold of this show. This show is hard, like I said, because it's one of those days where I don't know where to start, where to try to get some help to you, the listener, or to make it entertaining. When I think that it's one of those days where I think that we've already talked about everything before. Haven't we talked about all this before? Haven't we? So here's what I've come up with. And so it might be a short show, or it might go longer. Depends on if we start to flow, or if Chris has some good things to add.
What we'll do is we'll throw
like the trying on underwear. I mean, I never thought that would be on the show, and that's nice. We've made the show very diverse today. So anyway,
we'll throw in a commercial and give the illusion it was a longer show.
Okay, perfect. No, people will still be bored, and then we can't erase the illusion of boredom. So growth and income. People usually are talking about this, and when you're talking about investments, I want growth, I want income, blah, 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 blah. Okay, growth and income. They're basically two sides of the same coin. Okay? Growth means that when you get your statement, the money at the bottom of the statement, the total, most folks figure that that's growth when it's going up. Okay? But some of that growth depends on your investments. At least if I'm running the portfolio, some of that bottom total on the investment is going to come from some income that the companies have paid out in dividends. Okay, so, and whether that's reinvested in shares or whether it's in cash, it's still income that was generated from where? Okay. Most people talk like these two things are exclusive. I'm investing for growth. I'm investing for income, or what they'll say, you're old, you're about ready to not work anymore, or you're going to be retired, so we think you should invest for income. And they talk like it's some freaking different thing than investing for growth. Okay? So let's just put a very, very common sense wrapper on this. Most talk like they are exclusive of each other, yet they both come from the same place. That would be called profits. If a company's price per share is going up, and slash or for the grammatic cops out there, if they are paying a dividend, where's that money coming from? It's coming from them making money, called profits. So we're trying to find a profitable company. Yet my industry will throw up this big Wizard of Oz smoke screen. Are we investing for income or are we investing for growth? Which is it? Oh gosh, let's spend a half a day talking about the differences between, where I'm here to tell you, let's spend 2 minutes talking about the similarities and not a half a day on the differences. They're trying to make it complicated so they can justify their being on the planet or justify their being in my industry, okay? It's two sides of the same bloody coin. You have to have profits for you to get either to get growth or income. You can also, you can kind of skew this equation a little bit. You can have brand new companies that are out there like Tesla, where they've had growth of the stock price, but they've never made a penny. And I don't invest in companies like that. People can say 6 ways from next Tuesday, oh, they are doing this and they're really doing that. And these sentences are composed of different facts, and yet none of them will say, and Tesla's making a profit. They can say that they're building batteries, that that they've got a wonderful manufacturing facility, that they've really upended the automotive industry, yet they haven't made any damn money. So that's the key. If they've made money, I'll listen. If they're not making money, I'm not going to. And sometimes if they're making money and I think it's ludicrous, I'm not even going to mess around then, even sometimes to my own detriment. Way back before Starbucks was a publicly traded company, I was working in Seattle. Actually, in the area where people knew, I was getting I was getting coffee at Starbucks, paying big money for it. What I thought was big money because I had none.
Because it was Starbucks? Because you wanted to be somebody? Or was it just...
That was it.
That was it?
There was none of these little barista shops all over. That was it.
Oh, okay.
And they'd be, and it was completely well known, and it was really good coffee, and it was a nice place. This is before the internet. That was, you couldn't. It was more like a place to hang out or something. So, it was fun. They became public. People asked me if they should invest in it, and I started thinking, do you want to put all of your not all of your lifetime savings, do you want to put a portion of the money that you've saved up from working so hard just into a company that has this little stand of high-priced, really good tasting, but high-priced coffee? I don't know if it sounds reasonable. Well, you can see how that worked out. It was very reasonable, it turns out.
I was looking for the good part of that story.
No.
Okay.
No, there was no good part. It was Mike not being open-minded enough, not seeing the huge picture like Howard Schultz did. And so I will even make mistakes on that side. But later on, I started investing in Starbucks because you could tell that it was a very, very well-known, growing worldwide brand, and a person could have even invested in it before. So that's just me saying that I have some opinions, and I already know that they're not going to be right all the time, but I'm okay with that because they're opinions that are kind of carved out in the realm of what's called reality and profitability, not the reality or the pseudo-reality that's out there of the internet and other people's opinions, which I could care less about. So, growth and income. They're two sides of the same coin. And so finding when I have my industry talking and you see people on CNBC talking, and frankly, when I get questions from clients and prospects and so on, the questions are always, not always, but many, many times, they're a shade of gray of what I think is the huge supreme question is, how do we find a good, profitable company that will grow our wealth over time? And they do it in such a nice, balanced way that we can get a growing income stream from that as well. That's my purpose in life. And the second purpose is probably the primary purpose. How do I reassure my clients so they don't panic out? Because I know just from the first part of the show, my two notes were growth and income, same two sides of the same coin. Second sentence, most people talk like they're exclusive of each other, profits. And then if I was to wait for, let's say, 2 to 5 minutes, I know that most of the listeners out there would check their email, check the internet. If there was a commercial break going on, they would be checking something out there. They would be looking, they would be getting some information. Very soon thereafter, we'd be hit with emotions. There would be panic, there would be fear, or there might be questions. Well, why aren't we talking about this, or why aren't we talking about that? That's literally how it goes. 1.5 to 2.5 minutes of really good information and somebody's brain being engaged, and we're talking everybody's. And then we're talking about 10 minutes of lizard brain action, of fear, questions. Why aren't we talking about that? It can't be that simple, and so on and so forth. And so that's kind of what we're up against, is that lizard brain of ours is always trying to find something negative to be afraid of. And number two, the internet feeds into that completely. Every 5-10 minutes.
Well,
so
and you can always find people that agree with you instantly on the internet, no matter what side.
So anyway, that's the first topic that I wanted to bring up. Second topic is that I actually read a pretty good article in a recent investment magazine. It might have been Barron's, might have been somebody else. I'll
take your word for it.
Yeah, they were talking about making somebody's portfolio for retirement, how they are different from everybody else. And I kind of agreed with the article where they said that they want to invest in a preponderance of really good companies instead of a preponderance of bonds or insurance products or all of these other different products that are manufactured to try to take the volatility away to make people feel quote unquote safer. This person was of my camp saying that, hey, people are living a long time, and if we're going to have an income that we can depend on and that might actually grow over somebody's lifetime, we're going to have to own profitable companies. Okay, boom, I agree. The way that I plan for somebody's income right when we start is that I want to have like 1 to 2 years, maybe even a little bit more, but 1 to 2 years of income in cash. That way, when they first retire and they first start taking their income, we're pulling from a bucket that's full of cash. Cash doesn't earn us anything, but very, very critically, it doesn't have any risk to it. For that short of amount of time, there's no up and down movement of the cash. They're pulling money from that bucket for the first year, the first 2 years, and not touching any of the dividends or hopefully some of the growth in the portfolio of real investments. And that portfolio is getting a chance to build up a head of steam, to crank out a lot of dividends. And by the time the cash is used up for a year, year and a half, 2 years of paying the client income, there's already money flowing into the cash account from the dividends that will get them enough income for the successive years. But in the beginning, I start with a bucket full of cash for 1 to 2 years because to take away the risk of volatility. We don't want income coming from a place where the volatility isn't any worse than in any other day, but it's emotionally worse for a client typically because on the one side they're used to working and now they've crossed some barrier and now they're not working and they don't have a check coming in. To me, that's no big deal. To them, it's a huge deal. Yeah. Yeah.
And we're creatures of habit.
Exactly. So that's how I fight that. This article, back to this article that I was reading, the way that they did it was a little bit more complicated. They basically built, instead of a bucket of cash for 1 to 2 years, they built a bucket of bonds that they would spend down and use up over a period of 3, 4, or 5 years. And then, or maybe even a period of 10. The reason that I don't agree with that is that's, number one, too long to put a whole bunch of money into an asset class that isn't going to grow enough to matter. Number two, that's too much money that's too much money going into an asset class that actually has more risk than cash. If you own a bond that's long enough in maturity, in other words, it's going to be 2 or 3 years in length, then it's going to have some more risk to it than cash. And I don't want that risk. I want no risk. And that brings up the third topic that I wanted to just touch on. I have it written down here, talk about bonds. Okay, I want anybody listening to this podcast, I want you to search out, I think his name is James Grant. He used to write his own newsletter. I believe it was called The Interest Rate Observer. I can't be quite sure. Yeah, and Chris is smirking that is a pretty boring title.
Boy.
Yeah.
Just that title made me fall asleep.
Okay, well, if you're into getting some information on it, though, he's not boring. He doesn't write that anymore. He quit doing it or retired, and now he writes. He's an editorial. He writes an editorial for Barron's magazine now. He is very well written on bonds, and interest rates. Interest rates are what control bond prices going up and down. In the stock market, it's emotions. So in the bond market, it's purely math. And he has made several good points in the last few editorials that I've read that he's written, and they're great. Trying to remind people that the bond market typically moves in 30-year trends. So you had prices from Ronald Reagan to like 2014, 15, 16, maybe somewhere in there. You had interest rates that whole time period were actually going down. That's a long time for something to be behaving the same, don't you think? 30 years of the same behavior?
Name anything that has gone 30 years with the same behavior.
Okay, so we're talking. So we admit it's a long time period from Ronald Reagan, Jimmy Carter to a few years ago. You had interest rates trending downward. When you had interest rates trending downward, I don't want to explain why that it is. I just want you to know that it's a fact that when you've got declining interest rates, that is very helpful to your bond investments. So the prices on your bonds are going to kind of go up slowly, mathematically, over those 30 years. So humans being humans and humans being habitual, people are going to think after a 30-year good run, aren't people going to think that there's going to be a continuance of a good run?
Yeah.
Yeah.
Why not?
Yeah, exactly. It's not going to be that case. So now we're talking the other flip side is we're probably looking at another multi-decade period where interest rates are going to trend more upward. That's the opposite of what the past has been. So the people look at the past and they look at the published numbers of different bond investments and bond mutual funds, and they look at the 5, 10, 15, 20, 30-year numbers. They all look pretty good. And somebody that thinks that they might be doing enough investigation, they might say, well, hell, 30 years of performance, what more could I want? And they put their money in there. And then they're never happy again because they have not realized the true situation where interest rates tend to move in large time chunks and with demographic trends as well. So if we are sitting at a precipice right now where the interest rates are not supposed to, but could easily go up for the next 10 or 20 years, that does not bode well for a quote-unquote safe investment that a lot of people are piling money into as we speak. Money has been flowing into bond funds ever since the last big crash of 2007 and 2008. It's not slowed down because everybody's fear factor of wanting safety and getting even more fearful from whatever they read at the internet, they've been piling more money into bonds at exactly the wrong time, which to me makes exact sense when we're talking human beings with the psychology that's rooted in our DNA and our chromosomes from Lord knows how many years of evolution and society that isn't gearing you to make money by investing. You're looking for a pattern, you've seen a pattern, you're investing in that pattern, and the pattern just did a 180 on you. So that is why I use a cash bucket for clients right now initially to make sure for their next year to 2 years of income is in cash. That's why I do that, because I know right now that there's nothing else for me, and with my expertise and my opinion, I don't want to put $1 in the bond market when I expect interest rates to trend upward over time and therefore that will make my principal go down, which means it's not a good thing. It means I'm losing money for the client. So that's why I don't invest in bonds right now, and that's why people should be very, very, very careful. The past doesn't necessarily equal the future. Past is not prologue. And if you want to, get more information on that, make sure you go on the internet, even pay the money, try to find those articles of James Grant, the editorials written for Barron's Magazine. He will be much more eloquent than me. Chris can attest to that, right? Because you read that stuff all the time.
All the time. I can't get enough of it.
Yeah. So what are some other fun things? We're hopping topics here just to try to make it a little bit more of an interesting show today. Also,
speaking of all that, just reminded me of that quote. What is it? Men in Black. People are smart. A person is dumb, panicky, and scared.
No, a person is smart.
A person is smart. Yeah.
Yeah, but if you get a group of them,
yeah,
panicky.
You were just saying that everybody keeps dumping in because they go on the internet. Oh, look, everybody else is.
Yeah, and they look at the same thing everybody else is, which is the 10, 15, 20, and 30-year history of some mutual bond fund, and they're going to have their head handed to them. And that's the worst case scenario.
But at least if I do, I'll be with these 1,000 other people.
Another reasonable way to look at it is if somebody doesn't get killed, if interest rates don't shoot up, how far are they going to drop from where they are to get back to zero? Not very damn far. So you think that we're going to go into negative interest rates like the economic geniuses in Northern Europe? Those economic powerhouses where every single one of those countries has a GDP probably, well, for sure smaller than California, but probably smaller than Washington State. That's what we're going to base that on? Are you kidding me? So, yeah, people are not aware of the damage that can be done with rising interest rates when you own bonds. Okay, next topic here. Investment news versus the weather news. When you watch the weather on the local news or the national news, they're talking about the weather for today, right?
Usually, yes. Yeah.
And if we had some wicked storm, they'll even have pictures of weather that was yesterday, right?
If it was up in Maine and we had some wicked pissa, sure, you betcha.
And then the other thing that they're going to do is when you're watching the weather, they're going to talk about tomorrow's weather.
Yeah.
And maybe a 10-day forecast.
Maybe.
Okay, you can get it on your phone, right?
Not a whole lot of faith in their 10-day, and even they say it. But,
yeah, 7 or 10 day, and
it's 7 day.
It's actually IBM that's running those algorithms for the weather. So, our fact checker brought us the weather, and that is Saturday to Friday, so that's 7 days. That's a 7-day
forecast.
7-day
Your
forecast.
weekly forecast.
Yeah, so there we go. And since nobody expects them to talk about next January, they're kind of golden doing that, right?
Yeah.
Okay.
They're even golden really after Sunday because you forgot what they said by the other day.
Exactly. So this next January, what do you think the weather's going to be like?
I'm going to say cold, Mike.
Okay.
Chance of snow.
Okay. What about February? The same?
Yeah, about the same.
What do you think about the weather forecast for June 14th, 2020? Today, a year from today.
In California, it should be a nice 80 degrees because that's when I will be down at Star Wars Celebration. So,
I'm
willing the gods to make sure that day is. So you picked a wrong date. So anything before or after that, I have no idea.
Okay, but on that day, it's going to be heaven, I guess.
I've willed it. Yeah.
Okay.
I did the chicken bones, the 8-ball. Everything.
So look outside. Wouldn't you think that weather from a year today is going to be pretty much the same as it is today?
Pretty much.
Okay.
Give or take a degree.
That's my point. When you watch CNBC or you read any investment news anywhere, it's more like weather news. It's just anecdotal to me, and you should take it as an anecdote. people will take today's news. Like I'm looking at an article. It's a good article. It's June 3rd out of Barron's magazine called The Tech Trader. And he's talking about in here the chip manufacturers might have a tough future. Now, define future, okay? Define tough and define future. Well, they might not be selling as many computer chips for, and let's read from the article, in late April, Texas Instruments emphasized on its earnings call that semiconductor downturns typically last 4 to 5 quarters and pointed out that communication infrastructure demand may be choppy in the future. That same week, Intel gave 2019 guidance that was below expectations, saying it was taking a more cautious view for the year. And then on May 16th, NVIDIA cited low visibility in the data center market and withdrew full-year guidance it had given just 3 months earlier. Investors weren't pleased at the sudden lack of detail. NVIDIA shares are down 15% since the company went dark on its outlook. So that's factual. Yeah, it's interesting to me, but I never lose sight of the fact that we're talking 4 to 5 quarters. We're talking a year to 12 to 15 months.
And if I can be like a layman nerd here, in the tech industry, how do you even know? I mean, there could be some kid in his garage right now creating a hologram television or something. I mean, how can you predict in a year what you're going to be?
Well, Texas Instruments and Intel and those companies, you're right. They don't have as much ability to predict the future as people might think. But since they've been in the business for so many decades, they have the benefit of perspective of the history. So they're just being reasonable, telling people, hey, we expect this year not to be as profitable as last year because of this and this and this. And so you'll actually have people writing these articles wanting somebody to base their investment decisions on what this article calls out. So you want to base your investment decisions over the next 12 months? Are you kidding me?
Absolutely. On a piece of paper.
Not at all. I mean, it's such a short period of time that it's ludicrous to me. To me, since I invest in these companies, it's quite interesting to me, and it gives me a reason. It gives me some factoids to tell clients that, let's say 3 or 4 or 5 months from now, they realize that this year that Intel or Texas Instruments, the price per share hasn't gone up as much as they would like. I can tell them why. Or I can tell them this might be the reason why, that they've just sold less chips this year. Will that go on to in perpetuity? Are they just going to sell less and less and less until they go to zero? Probably not. When you've got people that you've got 5G communications, robotics, artificial intelligence, people putting more information on the cloud, all of that stuff requires computing power. These guys make the chips for that computing power. But things go in cycles, just like I was alluding to the weather. So you don't base a vacation on what the weather's going to be. You're just going to go on the vacation, typically. You're going to plan it out ahead, and that's when you're going, kind of like your Star Wars event. It is when it is. That's when you're doing it.
That's when it goes.
Yeah.
You hope it's good, but yeah, you have no idea.
And when you're investing for 5 and 10 years, yeah, we're hoping that any 1 year over another year is going to be good, but we have to know, just because we're realistic people, that not every year is going to be a barn burner. So anybody that tries to take information that's such short term, like out of this article, and actually base an investment decision on it, they're not investing. I don't know what it is they're doing, maybe speculating, but it's such a short time frame. And that's really what all investment news is, just like all weather news. It's short term in nature. There isn't a long-term investment news because nobody can tell the future. That's what makes my job so wonderful, is all the computer algorithms in the world can't replace me, because you're dealing with human emotions and marrying those human emotions to a portfolio that somebody has to be reassured and confident in for the next 10 years.
Well,
it's not an easy task.
You've got to add code about cursing and hating humans, and it's a huge deal. So most computers know they can't match you.
So anyway, that was that topic. And the last topic that I have is something on the cigarette companies. It's from, again, the June 3rd edition of Barron's. It's page 34. If you're looking at it on the internet, it is a column, I believe, called Other Voices, where it will have different writers. This week's column happened to be written by a guy by the name of Robert G. Eccles, or Eccles, Eccles, so I think Eccles might be.
Yeah, that's the way I'd say it.
Anyway, the title of it is Getting Big Tobacco to Quit Cigarettes. And it is a wonderfully written article, one page, about the tobacco industry. And basically he starts off by saying there's two types of investors out there. Those that simply avoid investing in tobacco and think that they're being good people by not investing in that horrible type of an industry. And then there's other people like me, and I'll read from the article. The second type are those who own tobacco stocks and have minimal, if any, engagement with these companies on matters concerning impact, especially the harm created by their products or what these companies can do to reduce it. These investors are attracted to tobacco stocks due to these companies' profitability, cash flow, ability to consistently deliver growing earnings, and dividends. And while some investors may harbor concerns about the long-term viability of the product, they don't see tobacco's decline as an immediate concern, and they are not wrong. So anyway, this article is talking. It's nice that it calls out the two types of folks in the world: the people that are okay with investing in cigarette companies, tobacco, and the people that aren't okay. And it makes several different call-outs in there that the people that are just avoiding the industry, thinking that they're being so wonderful by just avoiding it. And he also calls out that the whole industry is just slightly bigger in value as all of ExxonMobil. Slightly bigger, right? You could basically say almost the same. So all of the four largest companies traded in the U.S., Philip Morris, Altria, British American Tobacco, and Imperial Brands, all of them together equal one ExxonMobil. The point that he's trying to make in there is that when somebody's investing in tobacco, to not do like either one of the first two groups, not to avoid them and not to invest in them and just be happy to cash your checks and to be making the money, to be ready to actually engage with the cigarette companies and tell them that they could do so much more, that they could get away from cigarettes and go to more smokeless tobacco, that they could try to make the smokeless tobacco less harmful, that they could maybe try to make delivering nicotine in certain ways maybe slightly less addictive, that they could try to do several things. I would say in there easily, if it was ever federally regulated and not illegal, marijuana as well. But the tobacco companies have such huge brand names that they could do many things that would actually grow their earnings into the future that would make them less dependent on cancer-causing agents. And in order to do that, you kind of have to be an activist investor, not ignoring them. Also made as a point in the article that the population growth is so big worldwide that even though so many millions of people are quitting smoking each and every year, the population growth is so much that the actual number of people using tobacco is staying constant. So it's a very, very good article for both sides of the equation, for people like me that are willing to invest in them, and also for the other side, for people that don't want to invest in them because of the bad connotation. And very rarely do I read an article that's so well thought out that's just, wow, okay, that doesn't have an axe to grind in one area or another. Do you know what I mean? Yeah, it talks about basically both angles equally. And I think with that is a good spot to end the show. You have anything else to tell anybody out there other than your Star Wars epic adventure a year from now?
No, just make sure to tell everybody you named a lot of companies.
Oh, yeah. Named a lot of companies. None of them are solicitations to buy or sell. They are just for example and discussion purposes of this podcast.
There you go.
That's it.
That's all we got.
Thanks again for listening. We'll be back again with another week's time with another podcast for you to listen to. Thank you.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.